Well, we have to ponder a little about the global rise and fall in yields as well. I think we have a guest joining us on that. Yes, Ray Faris of Credit Suisse is joining us on the phone line from Singapore. Good morning, Ray. This has been one of the more confusing markets, the manner in which we saw German bonds and the US 10-year treasuries rise over the past, 8 weeks or so, and then this sudden fall yesterday. How should one expect bond yields to move in the days to come?
Well, I mean, a lot's going to depend on how today's employment data come out. If we get strong employment data out of the U.S., that will probably support this trend of higher yields, giving the moves that we've seen recently a U.S. element rather than just simply a European, German element. We tend to think that the illiquidity in markets, a lot of the swings are just simply a fact of the new regulatory regime that makes it more difficult for dealers to hold bonds. The last several days probably reflect a lot of position adjustment following some of the surprises from the ECB, at least in terms of its statements about liquidity. So 2-point swings in bonds on a daily basis, probably a bit excessive. That'll probably come down. But more volatile markets, as ECB President Draghi said, are something that we're just going to have to live with.
Okay. What in your view is, the trajectory that you expect to see on the currency front, Ray? Because we've seen the dollar index, get back to its gaining ways, and the rupee has been a tad bit under pressure, fairly resilient, but a tad bit under pressure in the last couple of days. Do you expect more upside for the dollar index in the next, say, 2 to 3 months?
Yes, we think the dollar will continue to rally and will sort of drive higher, driven by the Fed gradually moving its way to beginning to raise the Fed funds rate in September. Mm-hmm. We still think that September is likely to happen. That's because we see a recovery in the U.S. economy. We think payrolls today will come in around 220,000 with a fall in the unemployment rate. And as the U.S. economy recovers, the Fed's going to hike rates. And the ECB won't. So some of the sell-off in bonds will probably retrace a bit as markets clear out positions. U.S. yields, in contrast, will go higher, and that'll pull the dollar up. Mm-hmm. When the dollar is rallying against major currencies, it rallies against all emerging market currencies. So India is not unique in that respect. We think dollar India will probably go up to around 65 over the next several months as the dollar rallies against just about everything.
The huge rally in US bond yields and the German bonds, more so the US bond yields, has also led to people deserting emerging market equities to some extent. Will that trend continue for the near future?
Well, I think emerging market equities are much more of a mixed bag.
Yes, that of course.
And really kind of driven by country specific. So, when you say that people have deserted emerging market equities, certainly India's had weaker flows, as has, say, Thailand and the Philippines, in response to generally kind of, weaker earnings numbers. In contrast, there have been huge inflows into South Korea and huge inflows into Taiwan on a quarter-to-date basis. So the key for India in particular is going to be whether the economy begins to grow a little bit faster, whether the fiscal crunch that took place late last year, early this year, begins to abate, and government spending, begins to work its way through the system into the late summer and the early fall, and helping, to rekindle earnings growth. I think that'll be much more important than what will ultimately be very modest Fed tightening.
All right, Ray, we'll leave it at that. Thank you for giving us your thoughts. That's the word coming in on the bonds as well as on the currency market.